Welcome back. Well, Dipan Mehta, Director at Elixir Equities, is still with us, and we're talking stocks and what should you be doing with individual names. This morning, actually, there are two brokerages on ICICI Bank that have raised their target price. So, Kotak has raised it to 1,025 on ICICI Bank, and CLSA has a price target of 1,040. Dipan, this private sector banking space, especially names like ICICI Bank, have seen a huge outperformance lately. Do you think there's still more to go here?
Absolutely, Sonia. I think an ICICI Bank is going to be a great value creator going forward. It's entered a new growth phase with best-in-class credit growth, best-in-class operating metrics, and most of the NPAs are overall more or less done with. In fact, net NPA is 0.7, and they have got a 0.9% of the total loan book as some provisions which are being made as well for any contingency. So I think the bank is in great shape and gaining market share, I think, even at the expense of the other private sector banks. So I think ICICI Bank remains a must-have in your portfolio. In fact, should be among the top 3 or 4 holdings in your portfolio if you expect to outperform the Nifty and the Sensex.
Dipan, we spoke about a few specific names, Zomato, etc. You explained. Anything new you've bought recently? I mean, over the last many weeks?
Prashant, no, I think, as I said, we spoke about the 2 companies, Praj Industries and Vedant. They are on our watch list. So we're looking at that. And I think many companies came with interesting set of numbers. There's Action Construction, Varun Beverages you mentioned as well, I think came with good set of numbers. And some of our favorite mid-cap IT companies, Intellect Design, it's not done as well. But I think that certainly has a slightly different business model over there, which we find interesting. And then I think some of the NBFCs, I think the Cholamandalam looks quite interesting. Of course, Bajaj Finance has done exceptionally well. So there are a few nuggets here and there, and maybe the correction this week is a good opportunity to look at these stocks and see if they come to little reasonable levels and some amount of margin of safety is there or not.
Okay, Phil, the pre-opening rates are in and we'll address them in a bit. The currency has opened flat with a bit of a negative bias. I think that's okay, given the way the dollar index has behaved. But sort of Brent has remained benign after threatening to have a massive rally. So that could perhaps, there's a bit of a counter effort over there. But Dipan, I just wanted your thoughts on IRCTC. It's seen a massive rally over the last 3 or 4 days. Your thoughts? I mean, of course, personally, I mean, I'm a bit hesitant, nervous if, the data is monetized. But, they're saying that, it will be in line with all the IT acts and everything. But regardless of that, what's your view on the stock?
See, I think if it was cheaper, then Anuj, certainly it would be an interesting investment opportunity. But the stock has run up significantly. It's been a multi-bagger since its listing. And eventually, I think base effect will start to catch up. And it's a one-trick pony at this point of time. I think the main revenues just come from e-ticketing. And any changes in government policies, I think, can certainly impact those revenues over there. And this risk factor exists in all PSUs. I think the minute the PSUs start making bumper profit, the government does get tempted to try and get more of those profits for themselves and at the expense of the minority investors. We've seen that time and again in PSU stocks. So I'm a bit skeptical on that count. And I think a lot of the positives have been captured into IRCTC. I think if you're an existing investor sitting on profit, great, you can continue to own it and expect a decent inline market returns, but wouldn't advise fresh investment. Okay,
wouldn't advise fresh investment. Just wanted your thoughts on what's happening in the cement sector as well, because that's the next discussion that we're going to. With the whole Adani group now sort of receiving that SEBI approval for that $4 billion open offer to buy shares of Ambuja and ACC. Any of these stocks that you like from a long-term investor standpoint, Dipan?
Well, I think cement is entering a very interesting phase, and certainly I think shareholders of cement companies, minority shareholders, need to be very, very careful. I think that with the entry of Adani's, the entire sector is going to be shaken up completely. And the kind of price discipline which a lot of the companies have maintained, I think that may come under question, and you may see more aggressive marketing coming into play. Already the entry of Adani has forced the largest player to significantly advance its expansion plans. And I think all the large companies, ACC, Ambuja included, are looking at very aggressive capacity creation. And that can never be positive on a medium to long term, at least short to medium term basis, because it takes time to absorb all that capacity addition. and fresh capacities will act as a burden on the balance sheet, lower return ratios as well. So I think from a 2 to 3 year perspective, I'm a bit skeptical. I would say negative on cement, and there are better choices elsewhere. I think engineering, construction companies, real estate companies, all the consumers of cement may do much better than the cement companies per se.
Okay, let's actually take that discussion forward. In fact, the whole sector is in focus after the Adani Group received the SEBI approval for their $3.8 billion open offer to buy shares of Ambuja Cement and ACC. So Adani will offer 385 rupees per share for Ambuja and 2300 for ACC. We have someone who's been tracking this entire space very closely. Rakesh Arora, the founder at GoIndiaStock.com, joins us now. Rakesh, for the cement space, it's been under pressure for a while. It's not only underperformed, there's been volume pressure, there was pricing pressure as well a couple of months ago. Do you believe that the worst is over for the cement space overall?
Yeah, I think cement space came under pressure because of rising costs. Both coal cost as well as diesel cost went up quite sharply, and these two account for more than 30% of their costs. So there was margin pressure which came in. Cement companies, as you would expect, given the discipline, they would raise cement prices. They have done it, but the cost pressure was intense. Plus, government was giving all the signals to the cement sector not to raise prices given the inflation, and that's where the stocks were underperforming. But now petcoke prices have come down, diesel prices are coming down, so the worst is already behind us. And the cement prices are already up like 25-30 rupee per bag from where they were pre this rise in cost. So costs will come down, but prices will stick. So I'm very bullish on the cement sector from the medium term perspective. I think they used to do around 1,000 rupees per ton EBITDA margin. I think for the next 5 years, probably they'll do around 1,400 to 1,500 rupees per ton EBITDA margin. So that's what really makes for a bull case.
Okay, so what's the approach from here on between the large cap cement stocks and mid cap? Which ones do you prefer from an investor standpoint?
So among the large caps, clearly, you have Ambuja and ACC, which is seeing change of hands. And the only difference between them and Ultratech was the growth option. And with an aggressive promoter coming in, I think growth would be, there for the taking. I totally disagree with the previous, speaker. Ultratech was gaining market share at the expense of Ambuja and ACC. Now that balance will be restored. So I don't think there's going to be any, war or such. But, Ambuja and ACC will start to grow at around 8 to 10%, which is where the industry would be growing. And that is what is going to change the PE rating in line with where Ultratech has been trading in the last few years.
Rakesh, good morning. There are so many theories in the market, right? Especially with Ambuja and ACC, that the share prices have surged way above the open offer price. So obviously there will be no tendering in the open offer. But anyway, do you think these kind of prices are sustainable, the way they are trading?
Swaraj, you are expert in the market, but my 2 cents are that if investors are not willing to participate in this open offer and stocks have already moved up, there's no supply available at these levels. So that tells you something about where the investors or how the investors are thinking about the cement stocks. So I won't really worry too much whether something is tendered or not. There's no supply at this level for both these names.
Okay.
Rakesh, good morning. You said over the next 5 years, you expect companies to make from $1,000, you expect, a 50% increase in EBITDA per ton. What will broadly drive that, and do you see no sort of cost pressures along the way?
So Prashant, if you look at last 20-year history, cement prices have moved in a step-up fashion. So, the last step-up happened when there was a big increase in cost in 2005 or 6, where, overloading of trucks was banned in India, and freight costs jumped by 80%. So we saw that cement companies which were making around 400, 500 rupees per bag, 400 to 500 rupees per ton, jumped to around 900 to 1,000 rupees. Now, this cost pressure that we are seeing from coal and diesel has ensured that cement prices have moved up by around 25 to 30 rupee per bag. But I don't think coal prices can sustain at that $300 per ton level, or oil can sustain at $95-100. They both will come down. So if you look at historical evidence, cement price never comes down once it reaches a particular level. It's going to bounce out around that level only. So that's why I'm very bullish that margins will expand, and that is the reason, as I said, I'm very bullish on the medium-term model.
Okay, very bullish on the medium term. What about these stocks like Shree Cement, India Cements? I mean, Shree Cement, had done very well in the past. Do you think that it could sort of see some sort of outperformance yet again? And names like India Cement, Sanghi Industries, any thoughts here?
No, so Sonia, first of all, large caps have to move up. Ultratech is still like way below its all-time highs, and same is the case for Shree Cement. So the initial rally will be in large caps. Small caps and mid caps will take longer time. So I think it's too early to buy small caps. One should focus on large caps only.
Okay, Rakesh, we'll leave it. Sorry, Prashant.
Anuj, since we have Rakesh, just wanted to, so moving away from cement, Rakesh, I don't know if you're reading this commentary, at least the drought situation in China. Industries are starting to, basically the government is saying that leave power for consumers, so they're asking factories to to close down. I mean, of course, right now apparently it's under 1% of I think aluminum capacity, for example. China's own aluminum capacity is been shut down, but expectation is if it continues, more will be asked to shut down. It's energy intensive. Any thoughts at all in terms of what's going on? I mean, if you've looked at it.
Yeah, so Prashant, meaning there was like a 30-second bounce in commodities because of this, but it hasn't lasted. The reason is that demand destruction is happening at a much faster clip in China than this production reduction, that because of energy shortages. So I'm actually not so bullish on commodities. I think the worst is yet to come through. Demand destruction is happening at a much faster pace, and supply is still pretty sufficient. So that's why you see, on LME, aluminum hasn't really moved up. It's still stuck at around $2,400 per ton. In fact, once the coal prices start to correct, which should happen by end of the year, when this European winter season is behind us, I think we should see fresh downside in aluminium. It will probably go down to $2,000 level, which is where a fair price for aluminum.
Oh, wow. So you said worst is yet to come for commodities. Would that include steel as well, Rakesh? Because, the market's been building some expectation on export duty cut. But would that even matter? I mean, if the prices have to come down?
So, Anuj, you have put it very correctly. It doesn't matter. Actually, export tax hasn't had any impact on the Indian steel market as yet. The prices of steel which have fallen is largely tracked coking coal prices, which are down. But now the converse is playing out. Coking coal prices are picking up because a lot of shift is happening from the lower grade of coking coal to thermal coal, where there's high demand, and the steel prices are dropping because demand is going down. So there will be cost pressures in Q3 from rising coking coal, and I think the steel prices, which already dropped from 77,000 rupees per ton in India to 57, will probably go down to 51, 52,000.
Rakesh, we'll leave it there today. Thanks a lot for joining us. Good talking to you as always. The view on cement and of course metals as well. The pre-open has settled. There's quite a bit of pressure on the Bank Nifty because of Kotak Mahindra Bank. But that aside, it's important because on Friday as well, the Bank Nifty led the decline. It's the market leading index. And today as well, it's 0.75% down on the Bank Nifty. As I said, most of it is because of Kotak, but the other banks as well are down about 0.5%. Icici Bank and HDFC Bank as well down about 0.5%. So that's putting some pressure on the Bank Nifty. Mitesh, if we open here, do you attempt to buy it or leave it aside? And what's your 9-10 call?
I mean, still wait it out. I think closer to 17,500, 550, you would want to see some kind of strength coming into the markets before going along. And on the stock side, I think Maruti can be a stock which can give a pullback. So for the short-term period, I think sell with the stop at 88.35 for targets of 86.50.
Okay, so that's on Maruti. Well, for now, the pre-opening rates are settling. They're settling a bit lower. Nimesh is joining in to tell us about one stock that he's looking at. Nimesh, what do you have on your list?
Hi, Sonas. In fact, I'm looking out for two stocks, and both for technical reasons. The first is Piramal Enterprises. Late on Friday evening, post-market close for us, MSCI has decided to move the stock Piramal Enterprises to the small cap index from the standard index. Now, in the standard index, Piramal had an allocation of close to $150 million. Given that there is a demerger process which is on and the record date is August 30th, so the actual quantum of selling will not be known till the time that the demerge business gets out. So that's on 30th of August. But to start with, maybe you'll see some bit of red on the stock simply because the stock is getting moved from standard index to the small cap index in MSCI. So that's Piramal Enterprises. And second, of course, is Kotak Mahindra Bank. We highlighted in top 10 as well. To start with, the stock will be under pressure because it's not added to the FTSE world index as was the anticipation last week. The stock had moved out a bit, so you might see a bit of a reaction on the negative side in Kotak Mahindra Bank to start with. And the next FTSE review is in December. So before that, it's unlikely that it will be added. So both Piramal Enterprises and Kotak Mahindra Bank in focus, largely on back of the technical factors. Piramal for MSCI and Kotak Mahindra Bank for the FTSE rebound, not happening in this review.
Nimesh, thanks a lot for that. The other stock that we'll be tracking is Paytm because the shareholders have approved the reappointment of Vijay Shekhar Sharma, which was one talking point last week, but with overwhelming majority. So that's something that you'll keep an eye on as well. The first rates are in. The Nifty is down about 78 points. And the Bank Nifty is leading it, down about 300 points on the Bank Nifty. Remember, on Friday, I also made this point that perhaps the market is due for one pullback, which may not get bought. And from that point high to now, the Nifty is down over 300 points. In fact, the recent high was 17,980, thereabout. We're at 17,658 now. So it's a reasonable dip now that we're seeing. The Nifty is now down 100. It was down 200 on Friday, 100 down today. And the Bank Nifty is down 340 points now. So let's see how the screen behaves from here on. Kotak is starting the day with 3% decline, so that's leading the fall. Actually, that's the biggest reason that the Bank Nifty is down about 350 points now. What else? Tata Motors and Tata Steel are down. ONGC, Hindalco, so the commodity complex is down. Wipro is down about 2%. After Wipro, by the way, TCS is also delaying that variable payout to some employees. So, the theory that Wipro is perhaps a lead indicator for a large cap tech perhaps holds out. Cipla, Bajaj Finance, Axis Bank are the other 1% losers. Then you have ICICI and Infosys in terms of heavyweights, TCS, HDFC Bank, HDFC, which are putting a bit of pressure on the market. On the upside, you have Adani Ports, which has been one of the stocks of this month. It's up close to 3/4 of 1%. And I think there's a court case for Adani today, right? Maybe so that's something which could be something to watch out for. And SBI Life is higher, but the Nifty is now down 120 points and the Bank Nifty is down 430 points. So the first rates are looking quite bad.
Quite ugly, actually. Even the mid-cap index is down 330 points. The advanced decline ratio is well in favor of decline. So it's turning out, at least the start is on the negative side if you're a bull. The Adani Group stocks are all doing quite well. So they are bucking the trend today. Adani Green, Adani Power, all in the green, up about 3 to 5 odd percent. Paytm, for reasons that Anand just mentioned, up 2.5% today. You have a lot of pharma stocks that are doing well. Ajanta Pharma. I'm just talking about the stocks that are bucking the trend this morning. SBI Life, Deepak Fertilizers, KC International has been winning some orders, so looking good. Adani Enterprises as well in the green, and Thermax too is holding up in the green now. Central Bank of India is another stock that's up almost about 5 odd percent. Something like an AstraZeneca, IOB, etc. Are trading in the green right now. Tanla Platforms is in the news. It's up almost about 1.5%, so do keep an eye out on that. And on the downside, what's dragging the mid-cap index today? A lot of infrastructure stocks, some real estate names as well. Oil marketing companies are under quite a bit of pressure. HPCL is down 5.5%. Sugar stocks, Bajaj Hindustan down 3.5%. You have Indiabulls Housing, ONGC Sale, Kotak Mahindra Bank, of course, from the frontliners. And some stocks like Ashok Leyland, which have been rallying quite a bit, are coming in for some profit taking this morning. So all in all, you'd have to say it's a weak start, 117 points lower on the Nifty. But I guess a lot of people saw this coming because, we've had a very steep run up and some profit taking now.
I mean, I think this is one of the most seen and anticipated pullbacks, right? So nothing out of the ordinary at all. I mean, we've been highlighting how the market perhaps in the very near term has become a little more stretched. So these things happen. Piramal is down 2%. I think there was a Edelweiss note this morning highlighting about those index changes and how it's been excluded because of the demerger and some XYZ sort of selling has to come because of that. IRCTC is down 3%. So 713. Tata Elxsi, which has been such a huge outperformer, is down just 3%. Tata Chemicals is down 2%. These are pullbacks, mind you, nothing else. SRF is down 1.6. Deepak Nitrite is down 1.7. Jubilant Food is down about 2% right now. HPCL, Mindtree, Coforge, L&T Infotech, Naukri are some of the others which are coming off. Borosil Renewables is down 4.5%. So just kind of highlighting things with the largest amount of volumes at this point in time. 2:1, a little over 2:1 in terms of advanced decline ratio is what we had. And of course, we mentioned the Adani Group stocks, and the top 3 volume-led gainers are all Adani Group stocks, Adani Green being the leader there. Paytm is up about 3% as well. And we've got something like a Repco, which is up 8% now on decent-sized volumes as well. So that's quite something. DB Corp 14% now. So again, backed by volumes. But this is a lower start this Monday. Our market master of the day is with us. Nilesh Shah is Managing Director at Kotak Mahindra Asset Management Company. He is joining us to take some questions. Nilesh, it's always a pleasure having you with us here on the program. Thanks very much. Your thoughts, Nilesh, after the run-up that we've had and, slight pullback that we are now witnessing, just day 2 in terms of that.
I think now the market has to take a little bit of respite and even correct a little bit. This will be driven by variety of factors. One, the recently concluded quarterly earnings for June 22 quarter, that's marginally below expectation, driven mainly by some large stocks, and overall breadth of the earnings has been positive. So clearly, market has discounted breadth of the earning, but it probably has to discount some disappointments in larger names driven in automobile or in oil marketing companies. Second, globally, scenario doesn't look that good. There is a meeting at Jackson Hole where US Fed and other central bankers may try to be hawkish. That will weigh on the mind of the market. So we are at a stage where there is a need for consolidation, and the next move of the market will be dependent upon whether global uncertainty starts receding or starts increasing.
Nilesh Bhai, good morning. What's very interesting is that we needed almost about 20% of FI outflows. I mean, which has taken market almost back to highs. It's only this month there's been 18,000 crores of buying. I think selling was 10 times of this. So what does that tell you about the texture of the market and the retail flows? I know you're smiling because that's been one of your views. But overall, the texture of the market from the multi-year bull market point of view, what does that tell you?
I think there is far more confidence on India growth story because we are standing out like an oasis in the desert. Our inflation is lower than many of the global inflation averages. Our growth is higher than many of the global peers. More importantly, I think India offers a unique combination of growth. Our earnings growth are likely to be superior to our peers. Second, governance. Our corporate governance standards are far better than many of our peers. And third, returns which are green, as we are more conscious about environmental and social impact. This combination of 3G, growth, governance, and green becomes a very, very tempting offer for investors, be it local or be it global. The only concern right now is that our valuation continues to remain above historical averages vis-a-vis our peer group. We have always traded at a premium, but today the premium is higher than our historical average. Are we factoring in lots of good news? I hope and pray that others' valuation starts improving and hence the gap narrows rather than our valuation coming down.
Good way to put it, right? Let everyone grow instead of being jealous of someone else's growth. The market, by the way, Sonia, right now is seeing a sharp decline. The Bank Nifty is now down 540 points. Kotak is leading it, of course, but Axis as well is now participating along with ICICI Bank. So just keep an eye on the screen, because from the recent highs now, it's almost 400 points gone on the Nifty.
It is, yeah. So there's clearly a wave of profit taking, right? I mean, something that perhaps the street was expecting for a while. Nilesh, hi, good morning. I remember very clearly 4-5 weeks ago when we spoke to you, you said that this is, a big bull run that we're looking at. And look at the market. I mean, it's up, what, about 11-12% just in the last 2 months. Do you think that even if someone has perhaps missed out on this rally, right, there is this FOMO feeling that you get, people are still not ready to believe because there are so many macro issues still that exist, whether it's inflation, whether it's an impending recession. If someone has missed out on this rally, do you think one should jump in now, or do you think that you can just wait a bit, perhaps you'll get better levels?
So Sonia, it's always difficult to predict market. And my recommendation is, please do systematic transfer plan. Use every correction as an opportunity to invest. If you have X amount to invest based on your asset allocation, divide that into 12 installments to be invested over next six months or 12 fortnights. And whenever you see a correction like today, start investing. So instead of waiting for market correction, catch the bull by the horn, trying to split your money to get invested during correction phase.
Okay. So, all right. So, of course, the systematic investment plan is something that, one should continue doing and should not stop, irrespective of which way the markets are headed. But suppose one has a chunk of money that wants to invest right now in this phase. What are the sectors? I mean, is it like a top-down market, or is it a bottom-up approach that one should look at? And any sectoral biases that you have? For example, if one had invested in autos about 8 months ago, you would have made great returns up until now. Is there any big theme that you're looking at for the rest of the year?
So you'll have to invest on a bottom-up basis in a market like today. We have seen some of the large corporate names disappointing on results. But overall, 14 out of 20 sectors which we track at some level, they have given earnings which is better than or in line with expectations. So this time we are seeing breadth of the market giving decent earnings in line or ahead of expectations, but certain big names disappointing. Now, in this scenario, you have to be bottom up. From a sectoral point of view, at Kotak Mutual Fund, we have been bullish on capital goods and industrials. We believe these companies now have started receiving orders not only from government, but also from private sector as capacity utilization has started crossing pre-COVID level, and also from exports market. The China Plus One theme is working out in industrial and capital goods. Some of the multinational companies are probably looking at blistering pace of growth as they shift their sourcing from China to India. So overall, industrial and capital goods is one sector where we believe there will be great opportunity in the years to come. The second sector where we have been bullish and which is correcting today is banking. There is a consolidation in banking sector. Your deposits or your loans are likely to be from 5 to 6 banks. Second, NPAs are fully provided for. This time, our banking and financial system is fairly solid. And finally, as rates have increased, their margins are likely to improve as they have taken the hit on the treasury side. Put all these things in combination, banking and financial services along with industrial and capital goods appears to be outperformer in the market.
Nilesh, the point about industrials and capital goods, China Plus One, the broader theme seems to be manufacturing exports, right? I mean, that's the broader umbrella kind of thing.
Prashant,
yeah,
we have an advantage of all the three things because now all the three customers are firing. Government was earlier giving orders and their tax revenues are fairly solid. They are sitting on 3 to 4 lakh crore of cash to spend. The private sector capex has revived in renewable energy, in commodities, and exports market has opened up. So industrial and capital goods are likely to be firing in all the three engines.
what about areas like high quality companies in textiles and outside of this, where the theme is the same, which is manufacturing exports? And is there a product one can kind of invest in? I mean, I don't know. I mean, to kind of get exposure to this in one shot.
So, thank you for asking me this question. We had actually launched a product called Kotak Manufacturing Fund, purely on the theme of renaissance in manufacturing. Obviously, investor has to read the offer document and then take a decision in consultation with the distributor or advisor. But we remain fairly bullish on manufacturing theme. We think like what we did in IT services and generic pharma in two-wheeler automobiles, we are likely to repeat that in many other sectors like technical fibers, like electrics and electronic components, like auto components. So manufacturing will be seeing a kind of renaissance, what we saw in IT sector or generic pharma sector or chemical sector. And this is one fund which one should consider in consultation with the distributor or advisor.
Okay, Nilesh, since you spoke about IT and generic pharma, and they've done really great for us as a country, right? In terms of having our balance of payment issue sorted and the currency issue sorted. But stock-wise, especially pharma, it's not doing at all. In fact, it's been underperforming in a rising market, in a falling market, and even IT as well. There are question marks now on whether these stocks need to correct now because of the kind of valuation that they trade at. Your thoughts on both these?
So Anuj bhai, as you correctly mentioned, there's nothing wrong with the business per se in IT or technology sector, but valuations were way ahead of their fundamentals with the benefit of hindsight. Rarely we have seen mid-cap ITs trading above large-cap ITs valuation. Rarely we have seen large-cap ITs trading at this high valuation. Now probably prices are correcting or stabilizing so that fundamentals can catch up with them. There is undoubtedly uncertainty on global macro. Will companies continue to spend on technology? Will companies cut their budget on technology? That question mark remains, but undoubtedly from a business point of view, IT sector is doing well. It is the valuation which needs to get in line with the fundamentals. On the pharma side, unfortunately, we have seen a couple of disappointments. The expenditure on research or on sales and distribution has not been proportionate to the growth. The price drop in generic pharma in US and other markets has been fairly steep. And clearly in pharma sector, from a business point of view, delivery has been subdued, and that is reflected into those prices. In technology, valuations have to adjust. In pharma, even business have to deliver so that valuations can be justified.
Just one final question. I know we briefly discussed this, but wanted your thoughts on what one should do with the auto names now, because most of these stocks have seen a 30-40% gain this year already, whether it's M&M, Icici Motors, TVS, etc. And there is a flurry of new launches in the market. There's so much work for auto companies, auto ancillary manufacturers. Do you think this is the start of a structural uptrend in this space?
So in the auto sector, one big risk which continues to remain is if something happens to Taiwan. That's the global hub for manufacturing of semiconductor and chips. And if anything goes wrong over there, we will see the repeat of the cycle where chips are in short supply and automobile companies are not able to fulfill orders because of the raw material shortages. Subject to that limitation, we believe auto stocks have a very decent pullback. Their order books are fairly steady. The demand for motor cars and commercial vehicle has been strong. Two-wheelers has been subdued. So if you're looking to build a portfolio in automobile sector, my recommendation right now will be to go a little bit overweight on auto components rather than automobile manufacturers. Within automobiles, focus on commercial vehicles and motor passenger vehicles rather than two-wheelers.
Okay, Nilesh, we'll leave it there today. Thanks a lot for joining us. It's always good talking to you about all things market. Let's move on then. Balrampur Chini is the stock in focus. It posted a very weak set of Q1 earnings. Revenue slipped 2%. The profit after tax is down 80% versus last year. In more news, the center has hiked sugarcane a fair remunerative price or FRP for FY 22-23 by 15 rupees per quintal, and the export policy for the season is also expected soon. To discuss this, we are joined by Pramod Patwari, CFO at India's largest sugar company, Balrampur Chini. Mr. Patwari, good morning. Thanks a lot for joining us. After your last quarter's numbers came out, there was this sort of chatter whether the cyclicality factor is back. What else would explain this big decline in net profit? If you could explain that.
So, good morning, Anuj. I would say this as a cyclical, not as a cyclicality factor, but as a seasonality factor. So when a company loses gain to the extent of 16% in a particular crushing season, revenues as well as profitability are going to take a hit. So, but as a sector, we are seeing a lot of deleveraging is happening. Companies are making profit in spite of very high sugar production. Country is in a position to liquidate its surplus stock through export and diversion into ethanol. So the robust policies are in place, which is taking care of this surplus production through diversion into ethanol and exports. In our view, the cyclicality, the man-induced cyclicality is no more there.
That point is taken, but if you still look at the pure sugar business, there's been a fall of 22% quarter on quarter in your revenues. You continue to post losses on the EBIT front. There's a big loss actually of almost 56 crores. Just want to understand that, is this the expectation for the next couple of quarters as well? That purely the sugar business will continue to be loss-making, or any recovery is what you're expecting there?
Good morning, Sonia. So my point is still the same. Don't review the performance of the sugar company on a quarter-to-quarter basis, because there is a lot of variation in terms of production numbers. In quarter one, we hardly get any production. In quarter two, there is zero production. And the crushing begins sometime in the month of end October or November. So again, in the third quarter also, you will see nearly 40 to 45 days of operation. It is only the fourth quarter wherein we get the full benefit of production, and thereby the production over fixed overheads as well as the production overheads gets fully absorbed. So if you continue to see the performance of a company, sugar company, on a quarter to quarter basis, you will notice a wide variation.
The point here is, again, that brings the cyclicality factor, right, Mr. Patwari? Okay, maybe not quarter to quarter, but let's say for the full year then. What kind of earnings expectation should one have? I take the point that there could be seasonality. But year on year, from here on, what kind of earnings expectation should your shareholders have?
I would not like to give any future guidance on this, but to clear your point, on a full year basis, we don't see any loss in the sugar division.
No, you don't see any loss, but will the profit be lower than last year?
So again, it will tantamount to giving future guidance, Anuj. There will be profitability.
That. Okay, so and what's happening on export front, Mr. Patwari? Because there's clearly the new policy which will come out, but 2 or 3 points, right? Is export profit making now, given the price in the export market, or is domestic market sort of more reasonable? And what's your view on the policy itself?
So there is a lot of skepticism as far as the export policy is concerned because of the decision taken by the government a few months back. But I would not call that as putting any restriction or limit on the export. Rather, it is coming out of available for export. So we need to see what exactly is available for export. The government's thinking is very clear that they would like to have a 6 million ton of inventory at the close of the sugar season, that is 30th September, so that before the new sugar season or the new sugar hits the market for consumption, the existing demand can be filled. Now, as far as the next year's policy is concerned, I think maybe by end of this month or September, you will hear out something. In the past, we have seen the government has approached various methods. At some point in time, it was under OGR. At some point in time, it was under MAEQ. So government has seen the benefits or the outcome of both the methods. The kind of inventory which we are sitting at this point in time, which is 6 million ton, is one of the lowest in the recent history. So government would like to take a progressive approach on this after seeing the progress of the production in the ensuing sugar season.
Mr. Patwari, what about the ethanol business? What kind of growth? I mean, you may not want to give us any guidance, but how is the business doing at the moment? And what kind of growth do you see for the full year?
Yeah, we have said in the past also, our ongoing expansion program with respect to ethanol is underway, and it will be put to commercial production by end of November or maybe first week of December. After that, from fourth quarter onwards, we will have the capacity of 35 crore liters on an annual basis. So once we see the benefit of this entire 35 crores liter of ethanol for a full period, that is March 24, we are expecting ethanol division to contribute to the extent of around 35% in overall revenues.
35%. And in terms of profitability, how much will that contribute?
So again, the profitability will depend upon the transfer price of molasses. I'm not sure what would be the transfer price of molasses for B heavy going forward. But as far as the overall contribution of profitability from ethanol in the overall business of the company is concerned, it will be significantly higher from where we are today.
But Mr. Patwari, there's one school of thought which believes that, for a government which is facing so much inflation pressure and which has taken such extraordinary steps in terms of, if you look at the fuel products, the export duty or the windfall sort of gain tax, is ethanol going to be touched at some point? Or you think policy on that is fairly clear in terms of what kind of money you can make on ethanol?
As far as the ethanol prices are concerned, you will notice that these are announced on an annual basis. It is a function of FRP. If there is an increase in FRP, there will be a corresponding reflection of that in the ethanol prices. Number one. Number two, the objective of ethanol policy is to sacrifice or convert the excess sugar into ethanol. So somewhere the prices at which we are selling sugar into the market will also decide the ethanol prices. So we don't see any risk of revisiting this ethanol pricing mechanism.
In that sense, what's your view on the recent FRP increase which has been announced? Do you think that's quite benign?
Yeah, that will get reflected in ethanol prices. And this FRP increase has nothing to do as such with the UP SAP. Though it is too early to have any view on the UP SAP. But if you see the conduct of the government in the last 6-7 years, in 2015-16, UP SAP was at 280 and currently it is at 340. So over a period of 7 years, we have seen an increase of 70 rupees, which is extremely rational.
All right, so that's on the business. Just wanted to ask you before we let you go. Last year, there was a buyback that the company did. Any kind of plans to do either a dividend or a buyback this year?
So again, this will be decided by the board of the directors at relevant point in time. But if you see the past performance of the Balrampur on this account, in last 4-5 years, we have been continuously doing the buyback as well as the dividend. But what will be the strategy going forward? Only board of directors can decide.
All right, Mr. Patwari, we'll leave it there today. Thanks a lot for joining us. Good talking to you, and got some understanding of how things are placed in the sugar space. Well, the market right now is under pressure. To make no mistake about that, 17,604 is what you have. The 10-day exponential moving average was 17,645. So we're trading below that. We broke the 5-day average on Friday. The reason I'm mentioning these is because this is a momentum market, a parabola market, and in that you want to keep an eye on some of the near-term sort of momentum indicators and whether the market's taking support there. Let's see if we spend more time below 17,650, because that would perhaps weaken the market a bit. The next level, of course, to watch in terms of the moving averages is the 20-day DEMA, which is 17,317. But the Bank Nifty is the one which clearly stands out. 1.5% down on the Bank Nifty. Remember, it was the weaker index on Friday as well, and now you're seeing this move. In fact, if you look at the month-to-date move now on the Nifty, it's 2.5% now, still on the positive side, of course. On the Bank Nifty, which was sort of the outperformer, it's sort of now cooled off a bit. We'll take a break. Up next,